Today's market move wasn't just a rebound in prices, it reflected a shift in how investors are interpreting slower growth, inflation, and the path of policy. After the volatility we saw previously, markets staged a broad recovery. Equities moved higher across the board, with the Dow leading, followed by the S&P 500 and Nasdaq. At the same time, bond yields pulled back meaningfully, easing pressure on valuations. Volatility dropped sharply, signaling that the immediate sense of panic has faded. The US dollar weakened, while gold moved higher and oil declined, a combination that already hints at a more complex underlying narrative. So, what changed? At the core, today's reaction was driven by a subtle but important shift in expectations. Recent data points, including signs of cooling growth and moderating inflation, are reinforcing the idea that the economy may be slowing just enough to reduce pressure on central banks. In other words, the market is starting to see a window where policy doesn't need to remain aggressively restrictive. That shift matters because it directly affects financial conditions. As yields fall, discount rates ease, and when that happens, risk assets become more attractive almost immediately. But there's another layer to this. The decline in yields wasn't purely about optimism. It also reflects rising demand for safety and duration, which can signal that investors are becoming more cautious about the growth outlook ahead. So that dual interpretation is what makes today's move interesting. You saw it clearly in how capital was positioned. Money didn't flow into just one part of the market. It moved broadly. Cyclical sectors like industrials and consumer discretionary performed strongly, suggesting confidence in economic stability. But at the same time, defensive sectors like utilities and healthcare also attracted significant inflows. That's not typical for a high-conviction rally. It tells you that investors are adding risk, but not fully committing to it. They're participating in the upside while still protecting against downside scenarios. Even in commodities, the signals were mixed. Oil declined, pointing to softer demand expectations, while gold rose, suggesting continued demand for hedging. So underneath the surface, this wasn't a clean risk-on environment. It was a balanced repositioning, driven more by easing financial conditions than by a clear improvement in growth. And that leads to the key fragility. If yields are falling because inflation is cooling, that supports the market. But if yields are falling because growth is weakening faster than expected, that becomes a very different story. Right now, the market is leaning toward the more optimistic interpretation, but it hasn't fully resolved that tension. There are also structural risks still in play. Oil's decline may not just reflect easing inflation, it could be signaling weaker forward demand. Geopolitical risks haven't disappeared, and importantly, markets are becoming increasingly dependent on the idea that central banks will have flexibility. That leaves little margin for policy error. One question investors are quietly debating right now is this: are falling yields a sign of improving conditions or an early warning that growth is slowing more than expected? I'd be curious how you see that, whether this move feels like a healthy reset or something more fragile beneath the surface. Because when we step back, the broader macro signal becomes clearer. Today's rally wasn't driven by stronger fundamentals. It was driven by easier financial conditions. The market is shifting from a fear of inflation mindset towards a watching growth mindset, and that's a very different environment. Looking ahead, this narrative will be tested quickly. Upcoming inflation data will either validate or challenge the idea that price pressures are easing. Labor market data will show whether growth is slowing gradually or more sharply, and central bank communication will play a critical role in either reinforcing or pushing back against current expectations. At the same time, continued earnings signals, especially from large cap and AI-driven sectors, will test whether underlying demand remains resilient. So the next phase of the market won't be about today's relief. It will be about whether this balance between slowing growth and easing policy can actually hold. The broader takeaway from today's market reaction is that investors are responding to improving financial conditions, but not yet to proven economic strength. And that distinction matters, because it means the foundation of this rally is still being tested. If you find this type of calm, structured breakdown helpful, consider subscribing. I share regular briefings focused on the deeper forces shaping market behavior. And as always, thank you for spending a few minutes here.